So this is another rare case where the name of the company has become a verb. Now, my feeling about this company is I think they actually have the weakest moat of all the big mega cap companies that I've studied. I think there's just plenty of choice of what to watch, and there's just many players, big players, that are eating their lunch. Now, the bulls are going to tell me that, well, we all know that they spend all their money, they're spending more money than anyone else on creating the best content that everyone is hopefully going to love, and that makes Netflix very sticky for their customers. Look, I think it's a bit of a gamble. I don't think it's as sticky as people think. That's just my personal opinion. It's still a very, very good business. And I think streaming is here to stay. Is Netflix going to be the one that wins? I don't know. Is it going to be full of like many different players? I don't know. I don't like how they will just always forever need to spend just bucket loads of money to make new content. And who knows, maybe ChatGPT will create TV shows and digital actors will act and we will love it. That seems pretty far away. So I think my 10-year valuations are going to be safe enough. So let's try to get a feel for a fair price of Netflix stock. Okay, so working out the growth rates for the future obviously are super hard. So what I'm going to do is I'm going to look at the historical growth rates, read the annual reports, and get a feel for what I think the next 5 and 10 years holds for growth rates. A lot of adjustments are going to need to be made in the future, but let's have a feel for it right now, which I'm going to go for the revenues first. So it's gone from about 11.5 billion to 31.5 billion. So 11.5 to 31 billion over the 5 years gives us a compound annual growth rate of 22%. Now I'm going to compare that to the gross profit because margins looks like they've been expanding a little bit over time, which is good to see. So gross profit might be going a little bit quicker. Let's check. It's 3.6 to 12.4 over that time. 3.6 to 12.4 over the 5 years. So we're talking now about, looks like 28%. So we're somewhere in the mid 20s at the moment. So now I'll go have a look at the cash from operations. And unfortunately, we've got a negative number here. So because 5 years ago, they were spending more than the cash that they had coming in to now having about 4.6 billion of operating cash flow. So it's not really going to give us much of a good ballpark here. Now that's not going to give us much information because it's coming off a low base. We can't look at the growth rates here really. So the revenue number is probably not the worst way to go, but as you can sort of see, it's slowing down. We've gone from like in the 30s to high 20s down to the low 20s down to the teens down to 6.5%. Yeah, they can do things by increasing prices, but I think a lot of Netflix's runway and growth, I would argue that they've kind of reached that, but we've also remembered that they can do lots of little optimization things. Like if they've got this really great core audience, and even if it's growing just slowly, increasing prices, improving like operation efficiencies inside the business, things like that. Now, all of these assumptions around future growth rates, these calculations are going to require a lot of adjusting, more research. I'm going to keep track of all of this in a weekly report that I call Yes Stocks, No Stocks. There's a link in the description below for that. And you can get this each week for free. It isn't some boring newsletter. It's just straight to the valuations. There's no BS, there's no fluff. And I highly recommend you joining because a lot of the heavy lifting has now been done for you. So I'm going to say that they can keep going at about 15% per annum for the next 5 years, and then we're going to slow that down to 10%. Whether that's true or not, I'm not going to know until the 5 years obviously plays out. I think this is pretty optimistic, honestly. I would prefer to put this down to closer to 10%, but I'm just going to stick with the optimistic scenario at the moment just to see what this looks like. My return on investment goal, I've just put at 10%. Comparing that against all the other, this is how I calculate fair value. I've done the same with all the other mega caps. Essentially, it's a little bit above the S&P 500, which institutional investors would be interested in, getting a 10% return on your money. That's sort of what this number here represents. The multiple, if these growth rates could persist and they be such a great company like they have been in the past, they could probably warrant a 20 times multiple. Then I've got the operating cash flow minus maintenance capex number. So to get the operating cash flow, we just went into the cash flow statement and we got the operating cash flow number. There it is there, 4.6. Then what I did was I just Googled Netflix maintenance capex. And I go to Guru Focus, it comes up in the search results, and it tells you the maintenance capex number here of 356 million. So I minus that off the previous number, and we get the operating cash flow minus maintenance capex at 4.2 billion. So the shares outstanding number I've just pulled from the income statement. I go down here to see the average diluted shares outstanding, and I've just pulled that number there. And the total cash and total debt I pull from the balance sheet. So total cash here in short-term investments of 8.5. And I go down the bottom to look at the total debt of about 17. So 17 billion, that is. So I put all those numbers in, keep them all in billions. And it tells me that I want to buy the stock to get my 10% per annum return. Essentially, this is a fair value number of about 280, 300, somewhere around there. So I go over to a 5-year valuation model now, and I look at the current revenue number, and I put it in a 15% growth rate over the next 5 years, and that turns into about 64 billion in revenue. The free cash flow margins of the business, this might be able to improve to say 15% over time. It's about 13% at the moment. Let's give them the benefit of the doubt that they can improve that number. So their 5-year target free cash flow is going to be about 10 billion. Put a multiple on that of 20, and we got a target market cap of about 193, say 200 billion. Dilution rate hasn't really been happening. They have stock-based comp, but they've been buying back some stock. It averages out to about the same. Shares outstanding number I've put in. The current market cap for me at the moment, now depending on when you're watching this, you'd have to adjust this number, but for me it's 175 billion at the moment. And in 5 years' time, we've got a target market cap of 193, a target share price of 430, let's say, and a 5-year target share price of around 430. And based on today's stock price, that's only going to give us a 2% per annum return on our money. Because for me, the stock price right now is around about $400 a share. So I say somewhere between the DCF model that we did earlier, the 5-year valuation model, somewhere in between those numbers is somewhere at what we could call a fair value. Is it 430? Is it 280? Maybe in the middle at 350. I probably prefer to stick to closer to my 5-year valuation model. So maybe it is close to $400 a share. I was already pretty optimistic with these growth rates, so I actually want to keep it at 350. So I'm going to call fair value at the moment based on the current numbers, based on what I've understood from the annual reports, what I've understood of this business and its competitive advantage. I feel like 350 is definitely fair value. I don't want to pay over that. And I don't want to pay this number anyway, because that's really only going to get me 10% per annum. So if I go back to my DCF method and let's say I want to get closer to 22% return, well, we're now talking about $110 a share. An easy way to do this is you get the fair value number and cut that in half, and that's roughly 22%. So 350 divided by 2, 175, somewhere around there. So like 175 is somewhere, now it's starting to get interesting. But if we get to 175, maybe something's actually wrong with the business. I don't know what the market's going to do if the share price gets to that point. We are going to have to continually adjust and update this model and keep getting the latest information. And I'm going to update all of this in that weekly report in the description below called Yes Stocks, No Stocks. Now, I hope you've been enjoying my explanation of how I reach a fair value for many different stocks. Today's was Netflix. I've got many videos on my channel for a lot of the other mega cap companies. So I hope you've enjoyed the discovery process here with me. I will see you in the next video.